Hello, everyone. I'm Sean Walters. Welcome to the Exceptional Advisor podcast from the Investments and Wealth Institute, the premier professional association for the wealth management community. Each month, I sit down with leading thinkers and practitioners to talk about what's going on in the advisor profession, what's next, and what you can do with it. Today's conversation is about the future of wealth management and AI, the role that AI might be playing in that, and what advisors might do about both. My guest has had a front row seat to most of the changes in the profession the last 30 years, and he's spending most of his time these days thinking about what the next change is. So welcome, Mark Casady.
Thanks, Sean. It might be more like 45 years, but let's not be
Uh,
quibbling over
I'm
that.
trying to keep you in your 40s and early 50s
I,
there.
I wish you could. Maybe AI will be able to do that. It's just a matter of time.
Yeah, well, two avatars talking to each other.
Exactly.
So, Mark, in case you guys don't know Mark Casady, he's former chairman and CEO of LPL Financial, led that firm for more than a decade, took it public. Now he's co-founder and general partner of Vestigo Ventures, and he's executive chair at FMG and on the board of Savvy Wealth, an AI native RIA. Part of the reason we wanted to invite Mark today, outside of his extensive knowledge of all things AI and advice, and his podcast that Vestigo and his team does with Peter Diamandis. He co-authored a piece for us in our most recent Investments and Wealth Review issue on AI,
There we go.
apocalypse or renaissance. And I really liked, Mark, what you had to say in that. So we're going to talk about a few things that were in that article. Before we jump in, I always like to ask our guests, since we're a professional community of advisors and associations, are about people, who helped you get going early on in your career, and what did they say or do that kind of moved you onto the path of where you are today?
That's a great question. For me, there were two key people through my career in wealth management. The first was in the first decade of my career, which was at Northern Trust in Chicago. And I was going through the trust program where you actually, spent 2 years learning everything you need to learn about administering a trust, investing a trust, understanding fiduciary rules and those things. And the gentleman who was the chairman of the trust company was just this very elegant figure who you can imagine just knew all there was to know about families and family dynamics and the way wealth helps or hurts those families. So he was very influential in the early part of my career as someone to look up to, admire, revel in his intelligence around these issues and his ability to really get people to listen, which is of course a key issue in wealth management. And then the second person was at a company called Scudder Stevens and Clark, which actually wrote the book on fiduciary management for a fee. They created in the 1930s the first account that was essentially what we know today as an SMA. They did it for the local Fed chairman, and they wrote the book on investment advice for a fee. It still exists today. I have a digital copy of it because it's just so interesting to see. And the logic was the Fed chairman said of the local Boston Fed, look, right now you're selling me bonds. You're a bond sales house. So we're on opposite sides of a transaction. Why don't you join me on this side by putting together a bond portfolio, but then charging me an ongoing fee? Like earth shattering. What an idea. And that's what they did. And they created a really interesting firm as a result. And when I joined it in the 90s, mid 90s, the chairman of the company then, Dan Pierce, who's unfortunately now passed away, told me, to be in this business, you've got to have the mind of a capitalist or an economist and the heart of a social worker. And that has just resonated with me forever as a lovely way to think about our profession.
Yeah, yeah, that's really a good mix of skill sets. And you're right,
Yeah.
you're going to get into some of that when we talk about the meaning of money.
Yes. That's where it came from, that original thought.
Yeah, I'm sure over your years you've been an inspiration to so many advisors and kicking them down this profession or gently nudging them in this direction. Let's talk a little bit about the profession and AI. That's kind of dig in right there. There's around 300,000 advisors,
Mhm.
give or take, depending on who you ask.
Sure.
And, McKinsey Consulting recently, I guess early last year, came out with a report saying there'd be a shortfall of advisors. And, you know, There's been some questions around that, and some have said that McKinsey article is, more just trying to sell consulting services and into big firms to help address this shortage. And some people think that it might be the opposite. There's actually
Mhm.
too many advisors today. We're going to go more the
Mm.
route of insurance and have fewer advisors in the future. You, on the other hand, have taken that and said actually that McKinsey shortages is insufficient. There's actually room for more advisors than that
Mhm.
100,000 person shortfall.
Mhm.
So what do you think about this gap and why would the gap exist? Explain that to some of the listeners and how how will that be addressed in the future with need to be addressed in the future?
Yeah, happy to do that. And my view of this comes from the large business we had at LPR and they have today around supporting both insurance-based broker-dealers and financial advisors, RIAs, as well as supporting banks and credit unions. And when you went in to go measure their ability to cover, just their existing clients, they were woefully short, like 4 or 5 times short what they really needed to have. So if you had 50 people, you might have needed 200 people, 250 people to really cover just what you have existing in your footprint at local bank X. And I was struck by that. I thought that was interesting. And what it told you is if you have a smaller number, you become transactional and you aren't engaged in real advice and counsel. You're essentially, performing a transaction in one form or another. So you can see the missed opportunity immediately when that's the case. In working with independent financial advisors, they tended to be correctly staffed, if you will, for the business they had at hand. But what they didn't have was an organic growth strategy beyond the references that sort of naturally come in and beyond the natural predilection of these businesses to go up and to the right because of markets, right? They're a diversified portfolio and they get more valuable over time, as all diversified portfolios do. So it's pretty easy to build up your business and then kind of, enjoy it and enjoy your clients and not need to do much more. But the reality is, if we look at what's the opportunity, despite ourselves sometimes in this country, we produce an enormous amount of wealth. Enormous. The by far the largest economy, by far the most creation of millionaires. If you look at any studies recently, there's lots of concern about the concentration of wealth. I understand that. But the reality is what we're really seeing is an incredible lift out of poverty into affluence, from affluence into early upper affluence or high net worth. So in other words, you're just seeing a money making machine that is the U.S. economy. It's our entrepreneurial spirit. It's our ability to do things, get it wrong, and pick ourselves up and go and get it right. And I see it every day in what I do now in venture, which is constantly creating winners and losers in the space, and the winners come away with significant personal wealth as measured by anything. So I look at that and I think about what advisors are typically able to cover and say we've got a shortfall that not at 100,000, it might be 300,000. We might need to double the industry to do what we need to do, but we need to do that in a certain way. We can't just say let's, have more people and it'll all be fine. It's that they really do need to think about financial planning and counsel and the emotional parts that come with money are really critically important in that.
Yeah. So walk me through how you see the business model or the industry makeup for, let's just say, a doubling of the number of advisors. And you've worked with a broker dealer that supported the independent
Mhm.
side. You, of course, are familiar about half of the advisors out there more employee based. So there's
Yes.
like, what does that look like in the future? And this kind of gets into one of the questions I had about the RIA of one who we'll talk a little bit more about.
Yeah.
But how does the business model expand and be able to catch that growth?
So a few things. Most of my early career was in the employee-based model. Starting the first 11 years at Northern, where we're obviously all employees of the bank, and in a fiduciary trust role. So kind of a unique business model in our industry, but one that's very powerful and very personal in terms of advice and counsel. And then switched to the asset management world, and then came back to the advice world through LPL. But as you say, in the independent side, so have seen the wide range of businesses.
Yeah.
And I think in the end, that doesn't matter. That's just a structure, right? So I either feel comfortable taking on an office lease and figuring out payroll and doing those things that feel more entrepreneurial and feel, frankly, more administrative, right, that have to be done. Or I'd prefer to be in an employee structure where it allows for that world to go away. And I think one of the interesting things is my successor at LPL built the employee model they have today called LensGo, as a way to just say, pick your flavor. Which one do you want to have as a business model? So let's leave the business model aside. The core of advice in the end is about really helping someone think through their choices with the amount of wealth that they have. And it's as important to me if I have $1 million and I make $100,000, right, as it is if I have $100 million and I make $2 million a year, right? The issues are really the same. Now the ability to affect them are different, but the issues are the same emotionally. And that's really what's the missing gap here is there's just a lot of people who don't have access to or can, get to an advisor who can really get to know them, get to know their family, get to know their situation, and provide them, that insight and advice. And that's the missing gap for me. And if we had more individuals who could do it, basically you would see more uptake among, let's just keep it concentrated to the US, among US consumers. You'd also start to cover the parts of the market that financial advisors really stay away from, which are those who are near affluent, probably have some form of workplace savings, but don't really have much in the way of personal assets, maybe some home value. That's very tough for an advisor to make a living that way. So they avoid it. That's a natural way to go about it. But if you had more advisors and you'd figure out ways to make that segment of need covered, and this is one of the promises of technology is to make all that less expensive and more able to do it. So there's just lots of places to go in terms of market share and places to provide advice that we just haven't gone yet because generally we have a structure that has a certain cost to it and a certain way of doing things that won't work within the markets who are here. The last example I'll give are Henrys, right? People who are just starting out their career, they're high earners. That's the HE, but they're not yet rich. That's the rest of the anagram. And I think it's kind of a charming term because I have a grandson named Henry, so I like that. And so as I look at it, what's interesting about that is you'll hear plenty of advisors say, "No, I'm really focused on the Henry market," but they actually only have like 5% of their entire households in that market, or 10%. There's a lot more people who are Henrys, right, that are particularly in the millennial population these days that really need advice and could set themselves up to be in much better shape financially if they were getting that advice now in their 30s than they will when they get to their 40s or 50s when they have enough assets to be interesting to the industry. So imagine a world in which we could cover those and still make a living. We have to make a living. We're economic, animals. Um, and that's going to be an important change versus where we've been historically.
Yeah. Yeah, so it sounds like, and this is a good bridge to our the second question I had for you. It sounds like in order to handle the demand, the rising demand for advice and counsel on financial matters, that more of the advice profession is going to be focused on the meaning of money and less on the management of money. And that's something you've talked a little bit about. Maybe talk a little bit more about that and just give me a concrete picture of, if you've got a team of advisors all working around clients, how does that look on a Tuesday afternoon meeting with a client?
Yeah, there we go. That's a good place to imagine ourselves. So I've loved the term meaning of money versus management. I've said it till I'm blue in the face over the years. I need to trademark it, perhaps. That would be it's like a three-peat. If only I'd trademark it. But I don't trademark it partially because I don't think it's trademarkable, but partially because I want the world to think about it this way, which is what's this mean? Because the best financial advisors at LPL that I would speak to would say on that Tuesday afternoon, I spent 2 hours with my client and we spent an hour and 45 minutes on the dynamics between the husband and wife as the wife or the husband retired, right? So they're at that stage of now, enjoying the fruits of their labor and the dynamics of their relationship has changed dramatically. And they feel so comfortable with the financial advisor, they're actually talking to him or to her about it and getting advice from them from other couples that have been similarly situated. That might be the Tuesday afternoon. It might be parents who are, doing well that have children that are, 5, 7, 10. They're thinking about college planning on that Tuesday afternoon. And a key question is, are you going to pay for the child's college? Are you going to help them in some way? How are you thinking about these issues? Obviously, the earliest you can start with the child is as they're born, but most people don't tend to do that. They tend to think of it as they get to early double digits. And so, if I can just get you to awaken to the fact that we need to think about this issue and have a family philosophy around college pay, that would be important. And there's definitely people who we all know who would say, I'm not paying for my child's college. I had to pay for my own. And why would I do that? Somebody else who might say, I'm going to pay for part of it, but I'm going to make them pay for 20% of that college cost so they can get a sense of, value of money. None of these are right or wrong. They're philosophies, right? Or I might say, in the case of my wife and I, we said we're going to pay 100% of our kids' college because we had to put ourselves through school and it was hard. We paid on our student loans for a decade after college, and remember, this is the '80s, so it's a long time ago, and that just seemed like an enormous bill back then, relative to a young family trying to get started. And so for us, it was like this: we're just going to remove this obstacle. We want them to go to great schools. We want them to not think about this aspect. And then we want them to focus their money on our grandchildren and putting and doing the same for them. So let's teach them how to do that. So that's a family philosophy. That's the way we operate our family. There's a series of rules that go with that on the Tuesday afternoon that they've learned over the years. So it's really about getting that couple or that person or that family to discuss what's important to them in the area of their wealth or their aspiring wealth, and then living that philosophy cleanly. Because the problem isn't the management of money. We know how to do that. It's very easy to manage a portfolio in most cases. I don't want to take away from those who are really wonderful at finding excess returns in public markets. They exist. But the reality is getting someone into a diversified portfolio is fairly straightforward. So sitting down with me on a Tuesday afternoon and telling me how my portfolio is doing that's more than 5 minutes, I'm not interested in having that conversation. What I am interested in doing is understanding, how is our family doing? How's the philosophy around, our money management? How are we thinking about or anticipating issues that may be coming up, like the cost of medical expenses in retirement or whatever else the topic might be. So the more the advisor can get engaged with the family around these broader issues, the more they become part of the family, and the more they become a trusted advisor, which is what you're really after in the relationship, not somebody who is just a provider of a return. And the discussion is all around that.
Yeah. No, I in some of my discussions with other, association professionals, those fields, those professions that have a counseling or empathy or human dynamic to them tend to be a bit more, let's just say, AI resistant, right? Because those are the characteristics that AIs, at least today, having trouble replicating. Um, and so the meaning of money certainly fits within that. Having a partner who helps you with judgment rather
Yeah.
than, an interface with the internet that helps you with more information so that you ultimately then have to make a decision alone. That's what gets to be challenging for a lot of young professionals thinking about what they want to do in their career is where's my unique place in all this?
Right.
Um, so, I mean, this podcast is called the Exceptional Advisor Podcast. So when you think about what you just described, and the first question we asked about just are there too many advisors or not enough? 5 years from now, let's say a client calls you as a friend and just says, what should they expect from a great advisor in 5 years? Tell us how would you envision that, Mark? What does that advisor look like?
Yeah, I think that advisor exists, right? There are definitely some who believe they don't exist, that they will actually go to their favorite large language model, ChatGPT or Claude, and ask Claude the answer to that question of what they're thinking about. Certainly people will do that in much the same way, we search the internet when our knee hurts and we ask the question, why does it hurt? Right. So I can be better informed when I go talk to the human about, what my options are. So as I think about, what that looks like in 5 years time, I love this concept of the RAA of one, that effectively I have such an efficient infrastructure that I work with that I am totally focused on my emotional connection, my EQ interaction with my clients as opposed to my IQ or as opposed to the administrative process that this industry is great at creating, right? So we all know that you should be putting so much away into an IRA or into some other, retirement vehicle. We know that there's paperwork to be done when you want to gift, money to a child. By 5 years from now, that will all be automatic from a discussion we had, together, the client and the advisor. And the machines will take care of that. That's the beauty of AI. And it won't seem odd in 5 years' time because we'll be so used to it as consumers, starting in our life of buying things. Our favorite thing to do as humans, buy stuff. And
Mm.
so in the next year, right, we'll have examples where an agentic solution, a bot, might be another word, allows you to buy the thing that you just buy regularly. I use the example of Brooks Brothers shirts. I've worn them since I was a little boy. They've gotten a little bigger over the years, I'll say that. But I have to remember what my inventory is. And I have to about every 6 months go and order, a half dozen or a dozen or whatever I order in order to replenish my closet, right? Just everyone does it. I don't tend to walk in a store because I don't happen to like to do that, but that I could do it that way too. That won't be true in another year, right? I'll have some sort of solution that basically is either offered by Apple as part of my Apple Wallet, or is offered by Google as part of shopping, or is offered by Brooks Brothers that says, no, let's just understand what your inventory is, and then let's just automatically deal with these things for you, and let me give you parameters that you have to set from there. That's where we'll first experience it. So now imagine 5 years from now, you're having a conversation with your advisor. You'll already know where your portfolio is. You'll know how you're doing against your goals. That's the easy part. But what I won't know is how I'm feeling about all that and the issues that I've faced in the last year since I last sat down with you, or in the last 6 months, that I need help with on the EQ side. I've got a child who's in college and they're learning these amazing new skills, but I'm worried about them for this reason. What are ways to help them? So I think that you'll imagine an infrastructure in which you don't really need a lot of humans around to do the administrative part, and you really can focus on helping someone understand how they feel about and how they think about their money philosophy, their meaning of money for their family. And again, it doesn't matter the number of zeros, the issues are really still the same in my experience of working with individuals on their financial planning needs. The other thing is we'll have a much better array of tools, much better ways to understand how you think as an individual. Today you can scrape my LinkedIn and my Instagram, and you can know that I'm a fact-based buyer. So if you want to try to sell me something or talk to me about an issue, let's start with some facts. And somebody else might be an emotional-based, processor, and so we need to start with what's the story, what's the heart, how do we get to those issues. And again, in 5 years' time, the advisor will know that about this client or this prospect, and be able to be more effective in connecting with them human to human.
Yeah.
And that's what I think happens in 5 years: is the AI takes care of the drudgery, and we take care of the emotional part, which is just critical to getting right, for humans.
Yeah. Well, and my last question is related to that time horizon, 5 years to 7 years. You made a
Thank you.
comment in the article. I don't disagree with it, by the way. It's certainly I heard a term in 2020, kind of painting the decade as the turbulent 20s, and
Oh,
that has
that's good. Yeah,
certainly been the case,
certainly
right?
been true. Yeah.
And so, we still got a few more years left in the 20s and maybe a few more beyond that, before AI gets super intelligent or whatever. Um, so this rough and tumble period of the next 5 to 7 years, in the article you said you wish you could kind of Rip Van Winkle your way through 5 to 7, wake up and see, here's what has emerged.
Mhm.
What does this next 5 years look like? What makes it rough and tumble? And, what should advisors and firm leaders be bracing for or preparing for?
Yeah, it's a great perspective, and of course, none of us know what's going to happen, right? And the
Uh-uh.
one thing I have proven to myself over the last few years of watching, well, 2 years of watching generative AI play out, remembering that we're sitting in a shop where we've invested in AI as a technology since we opened 8 years ago. But before it was predictive AI, the kind that we all know about from the Turing machine and all those things, and then generative AI being the newest, appellation of that. And the reality is it's very hard to predict timelines. It's very hard to predict outcomes, because this technology is so amazingly fast. I will say it's going faster than I would have guessed. I just finished a conference at MIT, 250 speakers, amazing situation where you had Imagination and Action, a nonprofit, put together essentially a deep immersion in AI of all shapes and sizes. Highly recommend people going. It's typically in the spring, at MIT's Media Lab. And for me, that was a moment of going, "Oh my gosh, I'm sit in a lab where I see this every day from startups, and yet look how much faster this is all going." So 5 to 7 years feels like a long time from now. But we know a few things about this technology. One is it does, menial tasks pretty darn well in white collar work. And that's what's different than previous, revolutions. The Industrial Revolution took about 100 years. And of course, it was labor in its purest form. And yes, the world was better because the loom made the fabric rather than the human. But the reality is, getting from here to there was pretty rough. But you had 100 years to get there. And even if you said no, it was really more like 50, you still had 50 years to get there. So 2 generations. The problem is, this is going to be a half generation, a quarter generation skip to the new world of, highly automated white collar work. And that's scary because we graduate students today to learn that white collar work from colleges, if we focus on that population. And basically, we have them come out ready to be taught, almost in apprentice style, what it is they're going to do in wealth management or asset management or chemical engineering, whatever it is. So the more technical you are early on in your career, the better off you'll be, because that will give you a niche to work in where the human, interaction and thought process, even in 5 to 7 years, will still create innovations and ways to think about things that are just unique to the LLMs, which are an accumulation of the human knowledge over time. So I think that is one thing that will be true. The way I do it will change, right? In the past, I'd do 100 experiments to try to find something that worked. In the future, and even today, we can already see that AI can do 100 experiments virtually and tell you where to focus, but you still get to focus on something. So I think the turbulence comes from effectively the hollowing out of entry level jobs that can be better done by, the technology that is AI. And that then eliminates a group of people who otherwise would be climbing the ladder, up towards the pyramid or up towards whatever it is they want to do. It's that first decade of work that I think is particularly worrisome for me. After that, you become specialized enough, and there certainly will be new jobs to be done as well that will consume the labor that we have available to us at sort of 10 years out of experience. So we have to get through that period and understand how to retrain people. Some, for example, should go into vocational jobs. I don't see a robot yet able to do my plumbing, right? It'll
Yeah.
take a while. And so that would be an area where someone might specialize. For a while, we'd say, no matter what, go into computer, science, be a CS major, anywhere. And now people would say, "Oh, don't do that. The computers will do programming." They will, but understanding the mindset of programming is still going to be very valuable 5 or 7 years from now. But what's really important is for you to follow your passion. What's the thing that most excites you about the work in front of you? In financial advice, it might be exactly this issue of the meaning of money. It might be the social worker part of the job and less the economist part of the job. And if that's what ignites your passion, do that, because there will be places for you, because you're bringing the best thing you can do to that situation, and the best you will likely be a high performer. Somebody who's not happy in a job, somebody who's just kind of getting by, that's going to be a person who's going to have a real struggle in this next 5 to 7 years. So awaken your passion first would be my advice to someone who's entering college or just coming out. And then secondly, try to get as many reps in as you can through internship programs in college, or even if you have to do internships post college, that you doing those reps matter, and getting that experience matters a lot. But we're going to have to, as a society, figure out how to deal with some of the dislocation before some new roles start to show up.
Yeah.
To end this on a positive note of this section, I sit in a space which there's 150, soon to be 300 jobs that didn't exist a year ago. So I can tell you there is new employment being created, and not every one of those people are brilliant scientists from MIT from their CS labs. Many are, but at least a third of them are folks who came from schools like I came from, Indiana University, who did well in school, but I wouldn't say I was academically brilliant by any stretch of the imagination. But if I found my passion, it might be sales, for example. I can do that in an AI startup here, and you'll see people like that among the 150 that exist today that are in jobs that weren't here. So that there's definitely new employment occurring. I would encourage people to look, in that space, because the sooner you can acquire the skills around how to use AI in any profession, the better off you're going to be.
Yeah. No, I think that's a great advice. I one thought on that is just that,
Sure.
as a credentialing body, we do job analyses for
Mhm.
investment managers, private wealth advisors, retirement advisors.
Mm.
That's how we set our exams. That's how we then set the curriculum.
Mhm.
CFP board does the same approach. They added client psychology several years back to the body of knowledge after a job analysis.
Mm.
That's been the same path for us. Family dynamics for our certified private wealth advisor
Yes.
certification has just doubled in terms of the number of exam questions we have to ask on that because it's such a bigger part of
Yeah.
a wealth advisor's job is navigating the family dynamics,
Absolutely.
which are, you know, quite extensive, as wealth increases, right?
Yeah.
And,
It's just that it's more complex, just like taxes are more complex when you have
yeah,
more wealth. But again, the need to understand the emotion and get engaged with the client is really works at all levels. So that's fantastic that you've added, such an emphasis to those skills, those EQ skills.
yeah, and I think it emphasizes your point that the role is no longer just managing money. It's all this other stuff, and as the profession grows, more skill sets are gonna be needed within the practice, within the team to support different types of clients.
They will. I think it will tend to emphasize that the advisor has to have those as part of their work because there won't be other work to do, right? So typically today we might have a paraplanner, right, who does the actual machine work, putting together the details of a client's financial situation, then runs the software in order to get to an outcome. That will be done by agents. That won't be done by humans. So the paraplanner could move to being the emotional counselor alongside the advisor. That would be a
Mhm.
role that makes sense to me. In much the same way a nurse practitioner sits alongside the doctor, right? So I think we'll get new professional designations that are about that support system that would look a lot like what you might see in psychology or what you would see in the medical professions that are there. The example I use in medical is in 5 to 7 years, I'm certain a robot will do my knee replacement, right? That doesn't surprise me at all. It's already doing a fair amount of it already. But I'm going to want to talk to the human before the robot gets in there, right? I'm
Yeah.
going to want to understand what really happens. Give me that look in the eye and tell me it's okay, because I'm going to need that, right, in that moment. And I think most people do. They need that human connection to make it make sense. And again, the more complex their knee situation is, or the more complex their wealth situation is, the more they're going to want that human connection.
Yeah. Any just the last question then before we close, any piece of advice you'd give to advisors today?
First one is to really try to use these tools yourself, and ask your team to be using the tools. And a simple way to do that is just give them an institutional version of your favorite, device. So for some people, that's ChatGPT. For most people today in business situations, it's Claude from Anthropic. But give them one, and then also institutionalize it so you can protect the data, right? Because you don't want PII going into the system and being learned by the machine. So you can do that, and then importantly, if you don't do that, the problem is your staff is going to use their phone and they're going to ingest the data you have in order to do their job easier. It's just the way I've unfortunately seen this over and over again. So give them a safe environment to really practice, their AI skills, and do that for yourself. Spend a half an hour a week. Doesn't need to be more than that. Just trying to learn some way of doing some basic programming on Claude, or using, getting better at prompting for information. A lot of people do it, but I'm often surprised by how few people are willing to try it. It's safe. You can do it. It'll be okay. And then for financial advisors, I think, you've got to find the right partner, right, in this journey, who's got the bigger technology for your office understood, which is what, drew me to in our investment portfolio at Vestigo to Savvy Wealth. They're an AI native technology stack. They're one of only two in the industry. And that just gives them an enormous advantage. They already have examples of advisors who are doing investment advice with no staff, up to about $300 million of client assets. They're not bigger than that, but that tells you kind of the direction they're headed. And it also is why I joined FMG as executive chair, because you could see so many wonderful things that can be done with AI, in that environment. So not to plug those two companies specifically, but more to just say, as an advisor, look for partners who are forward thinking, and are really trying to help you in that environment. LPL certainly is doing a great deal in this space, as well as are many others in wealth management. So look for that right partner because this is going to be time. And then also accept that we don't know what's going to happen, right? I can give you my predictions of 5 to 7 years, but the reality is we're going to go on that journey together. And so learn to be flexible, learn to be, in the moment in terms of what might be happening. Don't be scared by it. This is the way humans advance. But recognize it is going to be a lot of change. And generally speaking, humans don't like change.
Yeah. Well, Mark, thank you again for spending the time here today. It's always great to hear your perspective on things. I really appreciate all you've done to just advance this profession over the decades, and thanks for all your commitment to the advice profession.
Thank you. You're very nice to say so. I feel so blessed to have chosen this profession. I originally thought I wanted to manage money. I thought, oh, I'm going to be a portfolio manager. Won't that be fun? Markets are fascinating to me. Deciding whether it's Ford or it's GM that I invest in seemed important to me. And as a senior in college, I get out, go to Northern Trust, great program there. I start managing money and go, oh, well, this isn't fun at all. I can't change this company. I can only sell its stock or I can buy its stock. But I really actually want to change the company. And so that's led me to management. And I've been very lucky to have some really interesting management assignments applying technology in the world and getting to know amazing people who do financial advice for a living. So it's been a very lucky career that way.
Yeah, a great profession.
It really is.
Well, thank you all for listening to the Exceptional Advisor today. Mark's article, The Rest of the AI Issue, is available at the Investments and Wealth Institute website. I encourage you to download that along with any of our other resources. And make sure you stay tuned to our podcast. We'll come out with another issue in another 2 or 3 weeks. Thanks for joining us, and I hope you guys have a great experience with your AI partner in the future.